Well, good morning, everyone, and thank you for joining our call today where we're going to unpack Secure Act 2.0. And it really is something that's going to reshape the retirement landscape for beginning immediately and for the years to come. Next slide, please. So our learning objectives really today is to get through the provisions of Secure Act 2.0. There's over 90, so we're not going to be able to spend a lot of time on all of them, but we will stop and try to absorb the information on new things for 401k plans, such as the emergency savings accounts, what's the new starter 401k plan, the focus on simple IRAs, what's changing for RMDs, how the MEP, PEP, and group of plan rules are changing, and then focus in on effective dates, which provisions are mandatory, and then which deadlines apply for plan amendments. Next slide, please. So we've broken this presentation down into these categories. First, we're going to spend a little bit of time on the background of the new law, how we got here. Then we're going to look at those provisions that affect employer-sponsored plans. Then we're going to go to some other plan-related provisions, and then some other little more remote or obscure provisions that are included in here. And then the law actually assigns some DOL and IRS homework that they have to complete in a timely manner. So we'll take a look at that as well. Next slide, please. So let's start off with our background of how we got here. It's really the Secure Act 2.0, and thank goodness that's what the actual final name of the plan or of the act was, because it's been referred to that, I think, ever since Secure Act 1.0 was enacted and more legislation was anticipated. So thank goodness they stuck with Secure Act 2.0. It's really the combination of three bills that came about in Congress in 2022. First, we had the Securing a Strong Retirement Act of 2021 that passed in the House and in March of 2022. Then we had two other bills come into play. One was called the Rise and Shine Act. Thank goodness for those clever folks in Congress who come up with these acronyms. And then we had the EARN Act. Both of those bills were introduced and then eventually passed unanimously in June of last year. So then the hard work started. Both the House and Senate had to sit down and agree to terms. And as a result of all the machinations, we came up with Secure Act 2.0, which is a subsection of the Consolidated Appropriations Act. That was our omnibus spending bill. So it's actually a smaller division of that big spending bill. And was signed into law on December 29th of 2022, and some provisions took effect immediately, and some will be taking effect through the coming years all the way through 2033. Next slide, please. So the key themes of Secure Act 2.0, this is what Congress and the administration was really trying to address. We're all aware of the retirement savings gap. That's been kind of a looming story out there for a number of years. So what Congress tried to do here in Secure Act was expand plan coverage, increase retirement savings, preserve retirement income as we are getting more focused on moving away from the accumulation mindset to actually retirement income and having enough income in retirement. And then finally, they were focused on simplifying and clarifying retirement plan rules so that employers would be more excited to offer retirement plans for their employees. Next slide, please. So now we're going to focus on some plan provisions that relate to just employer plans. And these first couple are for new plans or for employers who don't already have an existing plan. And what the law does is really sweetens the deal for small employers. And when I say small employers, we're talking about 50 or fewer employees. The plan startup credit that has been available, which was or is 50% up to $5,000 for the first 3 years if you had under 100 participants. This change sweetens the deal for those with 50 or fewer employees. It actually increases the credit to 100% of those setup and administrative costs for a plan up to $5,000 for those first 3 years. In addition to that, for those employers with fewer than 50 employees, they can get a second credit for contributions they make to employees, and the credit can be up to $1,000 per employee. Again, this is effective right away. Now, to claim that credit, the IRS is going to have to update Form 8881. That's actually the form that a plan sponsor would use to claim the credit, and that form is attached to the tax filing for the business. So that's a good news, extra credits there. Second in requirement for new plans is we have to have automatic enrollment in 401k plans and 403b plans. And this actually takes effect in 2025. However, what we're looking at is that if you if you had a plan established as of 12/29/2022, which was the enactment date of Secure Act 2.0, you're grandfathered, and so those plans established as of that date would not have to abide by the automatic enrollment requirement. But we do, for any plans that don't have that automatic enrollment, or some other exceptions that apply. For example, if your business has 10 or fewer employees, or if your business was in existence for fewer than 3 years, or if you are a church entity or a governmental entity, those exemptions also come into play. So we are looking at the needing to add an automatic enrollment provision to plans. And the formula, it's an eligible automatic contribution arrangement. And the formula has to be, for the first year, the deferral has to be at least 3%, could go all the way up to 10%, but at least 3%. And then it has to increase 1 percentage point every year over the next 8 years until at least reaching 10%. And it could actually go up to 15% if the employer wanted to implement that. Of course, the participants will have the ability to opt out or elect another percentage amount. So automatic enrollment is on the horizon for all plans, all new plans, I should say. Next slide, please. Some more immediately effective provisions. These will kind of breeze through quickly. Although they're kind of novel provisions. The first one is plan sponsors can offer immediate financial incentives to participate in 401k plans. If you recall, there was the rule that you could only make matching contributions, salary deferrals, contingent on matching contributions. But now we have the ability to offer a low value gift card. And when I know the question is going to come up, what is low value? And unfortunately, the law just refers to it as a de minimis amount. It doesn't name any small, value in particular. We're thinking $25 gift card to participate in the plan, but of course, we'll need to have more definitive guidance on that down the road. There's a new credit for small employers that will cover military spouses right away in retirement plans. Now, these are military spouses who are employed by the employer, but they can take advantage of a credit if they allow these military spouses to participate right away. And the spouses have to be immediately vested in all their employer contributions. So if they allow these military spouses to participate immediately, they can receive a maximum tax credit of up to $500. So another little perk for sponsors considering offering benefits to military spouses. Next up, I call this one the nanny SEP, or SEP nanny. It's kind of an interesting provision that would allow families or whatever that employ domestic employees like a nanny, or perhaps a cleaning person or whatever. They can actually provide SEP contributions for those individuals. This last one relates to elected cooperative retirement plans, just changing, how compensation is going to be looked at for those plans. So I think we'll move on to our next slide. QLACs. This is a nice change in that qualified longevity annuity contracts have been available to offer in plans of late, but they weren't all that appealing because the contribution limits were low. And so what this provision does is it repeals the 25% limit and allows up to $200,000 of the account balance to be used to purchase the QLAC, or the qualified longevity annuity contract. That really is increases the interest in using those in 401k plans per se. It also includes a free look back period of 90 days for the contract. So, an individual could, if they signed up for it, they could actually have 90 days to kind of say, no, decide I don't want to participate in that. And we do expect the Treasury will issue regulations within 18 months. That's the promise anyway. So we'll see to have more clarification on implementing or the further use of those QLACs. This next provision on qualified plans that hold annuity contracts and have cash in their account. It used to be that with respect to RMD rules, you had to satisfy the cash portion of the account separately from the annuity portion of the account. And now this is going to allow an individual to aggregate those two portions when they're determining their RMD and satisfying their RMD. This next provision is optional, and plan sponsors can actually choose not to recoup or attempt to recoup overpayments to participants. That's been a real kind of a sticky wicket in the past years for plan sponsors who, for whatever reason, overpay a participant. Maybe there was a matching contribution, and later on it was determined that too much was given to the participant, and then in the interim, the individual took a distribution. Technically that amount that was overpaid, the individual wasn't entitled to it. So does the plan go after the amount or not? And this provision allows plan fiduciaries to say, no, we're not going to go after those amounts. We're just going to let bygones be bygones, per se. And however, if the plan sponsor does decide to recoup those overpayments, there are some strict limitations on how they can go about it. So that's a decision, again, an optional provision that plan sponsors will have to take a look at and decide how they want to handle. Next slide. Here's another nice improvement to the Employee Plans Compliance Resolution System, or the EPCRS, the correction programs for plans. Contrary to popular belief, the IRS really does want to work with the plan sponsor to keep the plan functioning and correct errors without having to go to the extreme of disqualifying the plan. So to that goal, they're expanding the Employee Plans Compliance Resolution System to allow plans to do more self-corrections. So they're going to, allow certain loan errors to be self-corrected, certain failures related to taking required minimum distributions. That's going to be allowed to be corrected, just self-corrected without doing any filing with the IRS. And so we do need to have more clarification, and the IRS will be, and they have said that they will be updating the revenue procedure that outlines all the provisions, so we'll have clarity. But In the interim, it says as long as there's a good faith effort to follow the directive of the provision in Secure 2.0, that a lot of these errors can be corrected, within the plan without additional filings to the IRS. The next provision allows changes to deferral elections for governmental 457 plans. That's a nice change for plans because the election to defer in a 457 plan can be made at any time prior to the beginning of the receipt of the compensation. Before, it had to be made before the beginning of the month of receipt. So this is a little more lenient about when 457 plan participants can elect deferrals. Next slide, please. We've had in the past, plans have tried to implement the self-certifying ability to take hardship distributions, and there was always some question about how do we go about implementing the self-certification. And this provision in Secure 2.0 allows employers to specifically rely on employees self-certifying in the case of a hardship distribution. And so the employee can say that, yes, I have a hardship need. I certify that I have no other resources, and so I need to take the money out of the plan. It would be important that the plan sponsors still have documentation of that self-certification should the DOL or IRS take a look at the plan, and just to make sure that there is documentation that that self-certification did take place. One thing though, however, if the plan sponsor has knowledge that, let's say the employee did self-certify that they were entitled to the distribution, but the plan sponsor had knowledge that that was not true, in that case, the plan sponsor could not rely on that self-certification. And there again, documentation to support that decision is very important to have in the files. Next provision, retroactive salary deferrals for sole proprietors or partners or single member LLCs. And so this really allows the sole proprietor, all the proprietors, all the way up until their tax filing deadline, which is generally after the year that has concluded. They can actually go back and defer dollars into the plan, and as long as they do that, make that election by their tax filing deadline. Next slide, please. Again, just as the headline indicates, these are provisions that are immediately effective. Now, I'll caveat that with saying, they may be immediately effective. Are all the logistics worked out? Absolutely not. And there's still a lot of questions and that to be asked and answered. And a lot of these provisions will need to be worked out with plan providers and record keepers, TPAs, et cetera, to see how they are going to implement these various provisions. So again, while they are immediately effective, in theory, it may be a bit of a delay until all of this gets implemented, for sure. So let's see. One nice thing about the elimination of plan notices for participants that they're otherwise eligible, but they choose not to participate. And up until this point, plan sponsors would still have had to provide all the necessary notices, upfront and ongoing, et cetera. So what this provision does is simplifies that. If a plan sponsor has a number of participants number of employees who are otherwise eligible, but they choose not to participate, as long as that employer gives an annual reminder notice, and they provided a summary plan description when the participant was initially eligible and any updates to that SPD, then the sponsor can forego the ongoing notices during the year. So it should cut down on a lot of those unnecessary notices for participants. This next provision, it relates to public safety employees. There's several provisions that's really expanding the distribution ability. So in this case, the age 50 distribution rule, it was applicable for public safety employees. That's really now going to extend it to private sector firefighters. Next slide, please. Again, this is for public safety officers. It used to be a requirement that in order to purchase their long-term care insurance using plan assets, it had to be directly deposited or directly transferred to the insurance company. That's no longer the case. The next one, our age 50 public safety officer have abilities to take early distributions without penalty. And they are going to extend that to officers with 25 years of service as well. The exception to the 10% early distribution penalty for public safety officers is also going to be extended to state and local government employees. Next slide, please. Here's a big one. Optional treatment of employer match and non-elective contributions as Roth contributions. So this is an optional provision. Plan sponsors can decide to allow participants to elect to receive employer matching contributions and non-elective contributions as Roth contributions. Now, here's a key provision that we need to have a lot more guidance on how to implement this because it is going to be quite complex, especially for payroll departments and for record keepers, TPAs, how to actually do that. So here again, it's effective immediately, but the ability to take advantage of it right now is dependent on how we get all those logistics worked out. So again, this is it's an optional provision for 401k, 403b, and for governmental 457b plans. These they can elect to receive their non-elective and matching contributions as Roth. The contributions must be included in the individual's income, and so we're really going to need to get guidance on how these contributions are going to be treated for payroll purposes, withholding purposes, and reported, on income tax returns. So much more to come, but that's an exciting feature. And this one has no, dollar limit on it. If the plan allows for it, it can be used by highly compensated or non-highly compensated employees. Our next provision it relates to defined benefit plans, and in the past, if there was an overfunded defined benefit plan, we could use that overfunding to pay retirees' health and life insurance benefits. That was due to expire, I believe, in 2025. And what this does is it's going to extend that ability to purchase those health and life insurance benefits until 2032. The next one, it relates to domestic relations orders in a divorce situation. It really allows now tribal courts to issue domestic relations orders. And again, plan sponsors or plan administrators are the individuals that will need to actually qualify or determine whether it's a qualified domestic relations order, but those DROs can now be issued by tribal courts as well as state courts. Next slide, please. Removing RMD barriers to life annuities. The industry has been moving towards incorporating more lifetime income options, or trying to incorporate more lifetime income options in retirement plans and 401k plans. And annuities for a long time, and there were annuities in DC plans, and the plans generally got away from having life annuities, and now we're seeing the pendulum swing back to offering these life annuities in plans, but they weren't appealing because there were some roadblocks to being able to use them related to how RMDs would be satisfied. And so what this provision does is removes those roadblocks and makes it easier for plans to include the life annuities, and makes them more appealing for plan participants to sign up for those. Here's a welcome relief for required minimum distributions. In the past, if an individual failed to take an amount that was required, it was a hefty penalty of 50%. Now, there were a few exceptions, but the IRS was generally pretty tough on, if you failed to take what was due, 50% penalty applied. That's going to be reduced now, effective immediately, to 25%. And if you correct that error timely, I believe it's within 2 years, the penalty is actually going to be reduced to 10%. So welcome relief there for those who have delayed or failed to take RMDs on a timely basis. This next one is a clarification on qualified birth or adoption distributions. Those distributions now must be repaid, or if they're going to be repaid, must be done so within a 3-year period. In the past, there really wasn't a time limit on it, which made it very muddy and difficult for tracking purposes. So now there's a 3-year limit on repaying those qualified birth and adoption distributions. Next slide, please. Substantially equal periodic payments. For those of you who are familiar with those, individuals can set up these substantially equal periodic payments and take distributions early without incurring the 10% early distribution penalty tax. But the substantially equal periodic payment requirements were very strict. You couldn't take additional amounts. You couldn't move or transfer those dollars without violating the periodic payments and then incurring the penalty going all the way back to the start of when you set up those payments. What this does is really reduces the burden. So if you have substantially equal periodic payments set up either from a plan or an IRA, you can actually roll over those dollars. If it's in an annuity, it can be exchanged for a different annuity, as long as those payments continue to come out on a regular basis. So there's much relief there. As we go through these provisions, you'll notice there's a number of new exceptions to the early distribution penalty tax. And this one next is for individuals who are terminally ill. And this is going to be for individuals who self-certify. It is optional. Again, this is a provision that can be optional for plans to include. So it's not mandatory, but they could include these new early distribution penalty exceptions to the penalty. Next slide, please. Modifications to RMD rules, or RMD meaning required minimum distribution for special trusts. So what this basically says is if the beneficiary of a plan or an IRA is an individual that's disabled or special needs and has a special needs trust established for that individual, that trust can actually provide that any remaining distributions can be given to a charitable organization. Statute of limitations on excise taxes on IRA excesses and missed RMDs. There was unclarity related to what's the statute of limitations that applies in the case of, when an excise tax would apply to an IRA excess or an RMD. What this does is ties that statute of limitations to the Form 1040 filing for the individual. So it's a 3-year period that the statute of limitations runs for excess contributions. In the case of the RMD, that's going to be actually 6 years. Another distribution exception to the penalty if you take the distribution early for federal disaster distributions. In the past, the IRS has always come out with notices or alerts when there has been a federal disaster area determined, and usually the announcement would specify who is eligible for the disaster distributions. This just really kind of gives it a blanket approach to those qualified federal disaster areas and being able to take distributions from plans without penalty. Next slide, please. It is time for our first polling question. And the question is, the penalty for failure to take an RMD is changing from 50% to what percentage? Is it A, 5%, B, 20%, C, 25%, or D, 40%? And we'll get our Jeopardy theme song started here. Do, 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 do. That's enough of that. We'll let the powers that be tally our quick poll here. If you recall, we just spoke about the 50% penalty. Next slide, please, would be changing to 25%. That is correct. For those of you who remember that something about a 10% penalty, that is also going to be in effect if you correct the RMD delinquency within 2 years. So for this purpose, it was 25. So moving on, we will move on to our next slide. These provisions are actually going to be delayed, and for this first one, it will take effect in 2024. And this is really the first one that we're going to look at here relates to simple IRAs and 401k plans for employers with 25 or fewer employees. We're increasing the deferral and catch-up limits by 10%. For those employers with 26 to 100 employees, they can provide a higher deferral limit, but that means they would also have to provide a 4% matching or a 3% employer non-elective contribution. That's effective again for 2024. We are expecting the Treasury will give us further information on how to implement this provision in particular. But nice to see that we will have higher deferral and catch-up limits for simple IRAs. Simples really seem to have been garnered a lot of attention in this bill. I think, again, being a plan that, is relating to small employers that would be enticing for them to start something. Next provision is we're increasing the plan cash out limit from $5,000 to $7,000. That's effective for 2024. Next slide, please. Our starter 401k or 403b plan. This is effective for 2024. And an employer who does not already have a plan can offer this starter 401k plan or 403b if they are a type of entity that qualifies for 403b. And here again, employees would have to be enrolled at a deferral rate of 3% at least, could go up to 15%. But the catch here is the deferral limit is up to only the annual IRA contribution limit, which for 2023 is $6,500. Now, this takes effect in 2024. We'll have to see if there's an indexed limit in 2024. And then plus there would be a catch-up contribution limit for those over 50 and over. Next provision is something that will simplify service providers that have taken over default IRAs. So this relates to our plan cash out provision of increasing from $5,000 to $7,000. Plans can do automatic rollovers to default IRAs, and this allows those service providers that offer those default IRAs to have a simplified process to roll over those default IRAs to new employer plans for those individuals. Next slide, please. Here is the provision that creates emergency savings accounts for individuals. And again, this can be only for non-highly compensated employees. The savings account it's an optional provision, so it's not mandatory, but the plan can optionally enroll participants at 3%, and the contribution to the emergency savings is capped at $2,500, but the employer could set a lower limit if they chose to. There are some catches on the distributions from these emergency savings accounts. The first 4 distributions cannot be subject to fees, and they can choose to, once a person separates from service, they can take their emergency savings accounts and cash them or roll them over to a Roth IRA. A lot of times we get questions about, what is the treatment of those emergency savings dollars? Well, they're going to be treated as elective deferrals, subject, to the 402G limit. They could be matched, if the plan is providing a match, and they're going to be subject to all the annual contribution limits. The withdrawals can be up to $1,000 for emergency expenses. Next slide, please. Treatment of student loan. This is another hot topic because we've seen this in plans already, albeit under a little bit of different format, and really only allowed through private letter ruling, where a plan was allowed to, they called them matching contributions, but it was really a non-elective contribution that the employer was making related to payments of student loan debt. What this provision does is actually sanctifies this. It's not mandatory, so it could be, it's a provision, or excuse me, an optional provision that can be included. So the employer can actually match. They are actually going to be considered matching contributions. The employer can match payments made by an individual for their student loan debt. Moving on to the next one, we can have distributions, again, without the penalty for individuals who self-certified they are experiencing domestic abuse. So another optional provision of plan can include to allow access to dollars without penalty. The next item on the slide here allows employers to adopt discretionary amendments that increase a participant's benefits. So usually you have to adopt these provisions early on in the year. This allows an employer to, all the way up until its tax return due date, to adopt provisions that have a retroactive effective date, but as long as they are favorable or provide more favorable benefits for participants. Next slide, please. Defined benefit plans. This relates to those that offer DB plans, and there's been, the complaint in years gone by that when there's a lump sum offer, there's not enough information for a plan participant to decide, should I take a lump sum, should I take the annuity? So this requires pension plans to provide more information to help participants compare the in-plan benefits of, taking an annuity payment versus a lump sum. This provision is effective for 2024. That actually is a mandatory provision for defined benefit plans, as is this next provision. Eliminates RMDs from designated Roth accounts. You may be well aware that there was an inconsistency between Roth IRAs and designated Roth 401ks, in that on the Roth IRA side, Roth IRA owners were not required to take RMDs or required minimum distributions while they were alive. Only beneficiaries were required to start distributions. On the flip side, in designated 401k plans, you had to take an RMD. Now we've got an even playing field. This provision eliminates the RMDs for Roth 401k plans, and that's effective in 2024. Another mandatory provision is allowing a surviving spouse to elect to be treated as the deceased employee for RMD purposes. So it really basically allows the surviving spouse to step into the shoes of the deceased employee and continue RMDs just as the former participant had been. Next slide, please. This provision is an extension of something we've had for a while. There was a grace period of 9.5 months to after a plan year, and to correct penalty-free certain errors related to automatic enrollment and auto escalation features. Those were going, that extension of that 9-month period was going to be expiring. This now is being extended. So that is going to remain in place. We've got that 9.5 months to correct those auto escalation, auto enrollment errors. Another penalty exception for withdrawals for emergency expenses. That is different than our emergency savings account. So here is a separate provision that is optional for a plan to include. They can allow certain distributions to be exempt from the 10% early distribution penalty tax, and the distribution is limited to 1 per year, up to $1,000. The next item is a mandatory provision that plans will have to include. It increases the required minimum distribution age to 73. That is effective this year in 2023. And then in 2033, we'll see that RMD age increase to 75. Next slide, please. We are on to our next polling question. 401k arrangements established after what date must contain an auto-enrollment feature? Is it A, 2022, B, 2023, C, 2024, or D, that's never going to be a requirement? And we'll pause for a moment while we let the technical engineers tally our polling question here from the many attendees we have. It takes a little longer because we do have quite a few attendees today, so I really appreciate you dialing in today. So we talked about this, the provision taking effect that all new plans, unless you're exempt, you're grandfathered, or you have 10 or fewer employees, you would have to have an automatic enrollment feature after 2024. So it starts in 2025. Next slide, please. More delayed retirement provisions. These are actually effective in 2024. All catch-up contributions for plans are going to be required to be Roth. And that's except if you are an individual who earns $145,000 or less. So for those, lower, I shouldn't say lower income, but for those who earn less than the $145,000, you can continue making catch-up contributions as pre-tax or you could choose to make them as Roth. But for those with income above that amount, we're going to have those are all going to be Roth. And the reason that provision really it was included in Secure 2.0 was to pay for all of this. One of the important measures in order to get this legislation put through is it had to be basically revenue neutral, not adding any additional cost to the deficit or it had to be pay for itself, in other words. And so this is one of the provisions that helps pay for all the other provisions in the plan. We have a higher catch-up contribution limit in general for those individuals that are going to be reaching age 60, 62, and then 63. This is effective in 2025. And right now, it's the limit is somewhat vague in that it's the greater of $10,000 or 50% more than the regular catch-up contribution. Now, the regular catch-up contribution, we have to wait until 2025 to know what that is because it's now indexed. So it's a little bit of a moving target. So it's going to be at least $10,000, could be higher. The DOL is going to be creating a national retirement savings loss bound account. And so what plan sponsors are going to have to do is report to the Department of Labor any participants they've not been able to locate. This is going to be an interesting provision to try to accommodate in that plan sponsors are really going to have to provide information or in order for the DOL to build this database. It's going to be a searchable database, so participants can go online and try to locate if they have a plan balance that is still floating out there somewhere. Lots more information to come and is needed before we have a lot of detail on how that's going to be implemented, but just know that that is on the horizon. Next slide, please. We talked about for the last few years, the provision of having some kind of benchmark for asset allocation funds, and the best, example of one of those funds is target date funds. It's really been difficult to have any kind of a benchmarking process for target date funds, and as you know, as a fiduciary responsibility within a plan, if you're going to include investments, you really need to vet them carefully and take a look at benchmarks. So the DOL is given its assignment to create this benchmark process for asset allocation funds, including target date funds. We'll see that information hopefully in regulations that are due out in 2025. This next provision we'll get to is relates to our long-term part-time employees. That provision initially, was going to take effect, I believe, in 2024, and the look-back period was 3 years. The provision in Secure 2.0 reduces that to 2 years for a look-back period, and that's effective for 2025. Next slide, please. In this provision, we know that the IRS is looking to amend rules to allow consolidation of DC plan notices, another step to simplify processes. We hope they'll have that information out in 2025. We also have a provision effective in 2026. Permits retirement plans to distribute up to $2,500 to pay for premiums or certain long-term care insurance contracts. That $2,500 would be exempt from the 10% penalty. Here is a provision that is mandatory. The provision to have paper benefit statements, unless the participant elects otherwise. A defined contribution plan has to provide a paper benefit statement at least once annually, and for a defined benefit plan, it has to be done so every years. That's effective for 2026. Next slide, please. And here's our final polling question. Starting in 2033, RMDs must commence by what age? Is it A, age 59 and a half, B, 65, C, 72, D, 75? And I'll give you a little bit of a hint. It was kind of going to be a two-step process on when these provisions, we had the first bump up was going to be in 2023, and then there was going to be a second bump up in age in 2033. And according to our poll, let's see how our attendees did. Correct, D. In 2033, the RMD age will increase to age 75. This year, it is age 73. Next slide, please. Here are some things that the DOL is going to be doing, and IRS, I should say, as well. In this case, it's the IRS. They promised to issue some sample direct rollover forms for retirement plans and IRAs. So that should be interesting. I know that the forms participants generally find direct rollover forms very confusing, and they can be different between plans and IRAs, etc. So IRS is going to issue sample forms. We'll see how that plays out. We expect to see those in 2025. Let's see, I'll skip that second one just in the interest of time here. Savers match. This is an interesting change in that we are going to have the ability, rather than a credit, which individuals who participate in deferrals or put in IRA contributions could receive a credit for those contributions made. That credit is going to be changed to a match, and that match is going to be 50% of the contribution, up to $2,000 per individual. And rather than a credit, that amount is actually going to be deposited to an IRA or a retirement plan. So it's actually going to be dollars in the plan or IRA for the participating or putting in contributions to IRAs and retirement plans. Now, this is not going to take effect until 2027. Thank goodness, because it's going to take a while to figure out how that exactly is going to flow, in payroll, record keeper, etc. Next slide, please. Let's move on to just some general other plan provisions. I'll probably go through these pretty quickly. These all relate to MEPs, PEPs, and groups of plans. It's going to allow PEPs to name someone other than the employer to collect contributions. MEPs and PEPs can now include 403B plans. The 3-year plan startup credit can also be claimed if you're joining a MEP or PEP. Groups of plans, here's a question that was outstanding, that if the group of plan wanted to take advantage of filing collectively 15500, what happened with respect to the audit, the independent audit that might be required. And to clarify that, what the bill or the law now does is says if the plan individually in that group of plans has 100 or more participants, that plan would have to conduct the annual audit. And I think I already touched on that. MEPs and PEPs, you still qualify for the startup credit. Next slide, please. 403B specific provisions. Here's a question. For a while, 403B plans were not allowed to participate in group trusts, or might refer to them as collective investment trusts. This change, at least from the IRS perspective, would allow 403Bs to participate in collective investment trusts. Now, there's still hurdles, however, because Secure Act didn't amend the SEC rules that effectively prohibit investing in CITs at this time by 403B plans. So in theory, on the IRS side, IRS says it's okay, but not yet okay on the SEC side. Conforming hardship withdrawal rules to 403Bs to 401k plans. In the past, there was a kind of a glitch in our change to hardship distribution rules that had separate rules or different rules applying to 403B annuities versus 403B custodial accounts and 401k plans. Now, optionally, this isn't mandatory, but 403B plans can conform their hardship withdrawal rules to 401k plans. Next slide, please. Simple provisions. As I mentioned, simple IRAs are really kind of a hot topic in Secure Act 2.0. It's going to allow Roth contributions to simple IRAs as well as SEPs. There's going to be an ability for a sponsor to make additional non-elective contributions of up to 10%. To simple plans, and here's the idea of that if an employer has a simple plan in place, there's been the conundrum of how can I replace it during the year with a 401k plan. The provision allows that to take place without any worry of excess contributions. Next slide, please. ESOP provisions, I think in this interest of time, we'll just zip through there to the next slide. Defined benefit plan specific provisions. There's some changes with respect to cash balance and crediting rates. Also, variable rate premium indexing is gone. We're going to be using just a flat premium rate for unfunded vested benefits in a defined benefit plan. As I mentioned, the annual funding notices must be much more clear for defined benefit plans, as well as include information about lump sums versus annuities, etc. Next slide, please. Plan amendments. Here we're down to the nitty-gritty. Plan amendments are due the last day of the first plan year beginning on or after January 1st of 2025. So in essence, if you're on a calendar year plan, your amendments are going to be due by 12/31 of 2025. It is until 2027 for governmental plans. If you're going to operate your plan and incorporate some of these operational provisions before that, you must operationally comply with those provisions as of the effective date. The amendments also included all those prior amendments that have been due for COVID and some of our prior law changes as well. Next slide, please. Next slide, and here is just a laundry list of things that the DOL and IRS have promised to give us in the years to come. So we'll be on the lookout for those items. Next slide, please. Next slide. We have some IRA specific provisions. Oh, this one is good with respect to prohibited transactions in IRAs. If you had multiple IRAs and there was a PT or prohibited transaction, you are at risk of disqualifying all the IRAs. Now it's going to pinpoint only the IRA that is involved with a prohibited transaction for disqualification purposes. So that really cuts that back. Next slide, please. Here's an interesting one. If you have 529 accounts that have been in place for 15 years, these are 529 education accounts for beneficiaries for education purposes. They can actually do a rollover of up to $35,000 over the lifetime to a Roth IRA. So that's kind of a nice way to still be able to use some of those assets if you didn't use them in the 529 plan. We don't have an additional excess tax on corrective distributions or IRA excesses. And we're going to see indexed IRA catch-up limits. Next slide, please. I think at this point, these are just some of the more obscure provisions in the Act. I think we'll skip through and at this point sum it up and ask for questions.
Thank you so much, Jenny. Really appreciate it as always. Just to go ahead and cover for those that were asking, just as a recap from what Darren provided at the beginning, for those seeking CE credits, certificates will be emailed within about a week or two from Retirement Learning Center. They will specifically be coming from certificates@simplecert.net. So be sure to check your spam folder if you don't see those in your inbox right away. We have a whole lot of questions here, Jenny. For the interest of time, and to be respectful of your time, of course, we'll give it about 25 minutes or so. For those on the call, if we don't get to your question, please rest assured, we will absolutely make sure that your question gets passed to an appropriate subject matter expert who will provide an answer, and we'll get those answers out to you individually. So the first question I want to start off with here for you, Jenny, and we might bounce around a little bit based on provisions. I'll do my best to jump around the deck if I remember kind of where they are. But first question, general one, if an individual is over 72, but still working and contributing to 401k, so not required to begin RMDs when they retire, what rules apply to them? Must they start right away? Or if they haven't begun, do they fall under the new rules?
Oh, that is a really good question. If their plan that they are participating in does allow for them to delay RMDs until retirement, that rule still stays in place.
Great. Next question, can an inherited IRA be converted to a Roth IRA, or does it just have to be distributed in 10 years and possible RMDs?
Yes, there is a limit on, depending on the beneficiary of the IRA, what their ability to do a conversion. And then Sarah, what was the second part of that question?
Does it have to be distributed in 10 years, and then in parentheses they say and possible RMDs?
Yes, that's the case if the individual is what's considered a non-eligible designated beneficiary, so it's not the spouse, and those individuals are subject to that 10-year payout requirement, and that was a change that took place about 2 years ago, sorry.
Okay, next one, how do you get the credit for plan startup costs?
Oh, great question. I love it because I know the answer to this. The plan sponsor would file Form 8881, and there is an existing form out there now. It will have to be updated, of course, to reflect the changes for those employers with the 50 and fewer participants, but it is Form 8881. You can go up right now and pull up the form and instructions. And that form is attached to the plan sponsor's tax return.
Great, and who handles the tax questions for the tax credit? Is it the TPA or the client's accountant?
I think it's going to take probably both in looking at identifying what are the startup startup costs. So it's anything to start the plan and administer the plan within those first 3 years. So I can see involvement, from the TPA and the tax accountant to make sure that they're reporting it correctly on the form.
Great, and this next one I believe has to do with a specific provision, but it talks about cumulative 5,000. Is that every 3 years, or is it 5,000 total over 3 years?
That's 5,000 each year, so up to $5,000 in each of the 3 years.
Great. Next one, does the plan electing auto-enrollment for the first time, are they eligible for the credit if the PEP has been in existence for 3 years?
That was a provision that clarified here in Secure 2.0 that that 3-year period relates just to the employer joining the MEP or PEP. So let's say the MEP or PEP was in place, for three years already, and an employer joins it for the first time. That 3-year period relates to the employer, not the PEP or MEP.
Great. And what was the form number for the credits for simple IRA employers?
Yeah, it's form 8881.
Perfect. Next one, can a group that terminates a simple IRA and starts a K plan still be eligible for the full credit?
I don't know that we have specific guidance on that yet, but I would say it would certainly be, I would say that, you know, you encourage the cost to do the simple and then you upgrade it to your 401k. I would say that would still be eligible for that 3-year period to cover those costs.
Great. Next one, the new tax credit does not apply to existing 401k plans, correct? If the employer transfers the 401k plan to a new service provider, will the credit apply?
No, it relates to when the plan you know, came into existence. So, you know, if you've had your plan for 5 years and you're changing it to a new service provider, unfortunately, you know, you're past that, you know, that 3-year window.
Great. Next one, with respect to auto-enrollment, if plans that existed as of 12/29/2022 are grandfathered and this provision starts 1-1/2025, what is the status of plans opened during 2023 and 2024?
Yeah, this is an interesting one. It was for those established in 2023 and 2024, while they don't have to have the automatic enrollment feature for those 2 years, they would have to add it beginning 2025. I did just do a case of the week that it should be posted on TRA's site related to that question in particular.
Great. Next one, IRS hasn't updated SEP Form 5305 to allow Roth contributions yet. Can we deduct Roth contributions now, or do we need to wait?
I would say to give it a little bit of time, and we might, you know, if depending on how quickly the IRS can get to updating some of these forms, I would say give it a little bit of time, and we'll see if we get any further, you know, additional guidance. We're gonna, before we, you know, start doing something and then we have to undo it, given the guidance that does come out.
Great. Next question. If a plan was implemented in January 2023 for tax year 2022, would it be eligible for these credits and benefits?
Yes. Yes. So for if it was effective for 2022, then, you know, the costs for 2022, 2023, and 2024 would be what would make up that 3-year period.
Great. Next one, does the increase in tax credits to start a new plan have to deal with number of non-highly comped employees like Secure 1.0, or is it an automatic 100% credit for all under 50 employees?
I believe it is for all. Let me just double check, but I don't believe there's any requirement that it be non-highly compensated here. Let me just take a quick look at my notes here. Yeah, there's no indication that it has to be non-highly.
Okay, great. Next one, in relation to hardships, it says the plan sponsor may rely on employee self-certifying. So they can opt out, or they can opt to let them self-certify or not, their choice?
It would be I see, the provision is optional. So a plan sponsor could decide to adopt whether they will approve hardship distributions via self-certification. That's the optional part, that the sponsor doesn't have to allow for self-certification, but it can.
Great. This next one, which type of plans are affected? Simples, etc.
What types of plans are effective in particular? Is there with a?
I think this is just in general. That's all the question was.
Okay. Yeah, I mean, they're basically they're all types of 401ks, SEPs, simples. This affects all of those types of plans.
Great. Next one here. For those sole props who have not set up a solo K in 2022 because of various reasons, can they set one up now and fund it before tax deadline 2023 for 2022?
I'm sorry, could you repeat that again?
Yes, for those sole props who have not set up a solo K in 2022 because of various reasons, can they set one up now and fund it before tax deadline 2023 for 2022?
That relates, okay, the effective date for the sole proprietor. Let's see here. I'm so glad I keep my notes handy because I can't remember all of it. That is effective for 2023. So yes, yeah, it is possible that they could, for plan years beginning after 2022. So it would be effective for the 2023. That's the first year that they could do that, for 2023.
Right, and next one, just I think general statement, a summary of the required provisions only would be helpful versus the many optional ones. Can we provide any pieces that would provide that sort of a breakdown in the near future?
Yes, actually, I do have a piece that I've highlighted what are mandatory and what are optional. So I will get that over and so that can be shared.
Yeah, what we'll do is for that person that asked, we'll make sure that that is included as a link in the supporting material in the follow-up emails, which will go out roughly about 24 hours from now. You can expect to see it in there. Thank you. Next question for you here, Jenny. Does the employer get a tax deduction when providing a matching contribution as a Roth contribution?
Yes, they would still be able to receive a deduction for the contribution made. It's really just a matter of how that the participant is going to account for the income for the Roth contribution.
Great. Next, any thoughts on Roth match if elected would be deductible by the employer?
Yes, I would say that it would be deductible by the employer. Again, we're hopefully we'll have guidance onto how exactly that's all going to be handled on the business business from the business perspective and also from the individual perspective.
Great. Next one. When is mandatory automatic enrollment effective, and is that true for simple plans too?
Yeah, mandatory auto enrollment is effective for 2025, and it applies to, let me just double check my notes. That's 403B and 401K plans.
Okay, next one. Are the safe harbor notice requirements still in place?
Yes, they are in place. And actually, I think there was a technical correction included in Secure Act that reaffirmed that, and also for QACAs, or the Qualified Automatic Contribution Arrangements. But yes, those are due. Let's see, I was going to say there is, if you're adding the 3% non-elective, I think there is an exception to providing the notice in that case. But generally, yes, there needs to be that upfront notice.
Great. Next one. If an employer has a simple IRA and switches to a 401k plan for 2023 or beyond, are they eligible for the startup credits?
I believe so. I think right now we haven't seen any specific guidance that on the link between those two. But to me, it would seem that if you were able to, you still have a plan. within the first 3 years, I would say that though you would still be able to take advantage of that tax credit, even though you're upgrading to the 401k plan. One question I wanted to go back to, because I think I wanted to clarify, because I think I might have misspoken about the startup tax credit. And so there is the requirement that the plan have at least one non-highly compensated employee to be able to take advantage of that. I think I said that there was no non-highly compensated requirement, but there is the requirement to have at least one.
Okay, great. Next one is the starter 401k limited to pre-tax deferrals, or does it include Roth?
Let me see. That's a good question. I think it might. I think it includes both. But let me just double check here if I can take a look at my notes here again. Yeah, it doesn't seem to indicate that it has to be one or the other. So I would say that both would be permissible.
Okay, great. The next couple here, I made a slight mental note to remember kind of where to jump back to. So I'm going to hop back here in relation to this second provision here on the screen. Is the cash out limit increase from 5K to 7K mandatory or optional? What if we only cash out under $100 currently?
That is optional. Yeah, so that is, the plan can choose to incorporate that or not.
Okay, great. And this next one, I believe, is right around here. In this first one here, is this $2,500 per lifetime or per year?
Let's see. Oh, they must be talking about the emergency savings account.
Yes, in this top one here.
Yeah, that's actually the account cannot exceed 2,500. Period. So once there's this, on the 401k record keeping platform, there's this separate little bucket, so to speak, for the emergency savings account. And that can only be up to $2,500. So nothing can go in it after that.
Okay, great. So if the plan is safe harbor, in parentheses, or any match, does that money have to be matched?
Oh, if they're providing a non-elective in a safe harbor plan, I would say
the additional context isn't here, but I'll let you make those.
Yeah, yep. That is a good question that I'm not sure I can answer completely at this point. I mean, we know we have the ability to do the non-elective or match as Roth. I would say that it would apply, but without digging in further, that's I would just say probably, but I can't say definitively at this point.
Okay, great. There was a general question about whether you could briefly cover over the provision on TH testing.
Oh, top heavy. Okay. Yeah. That's kind of an interesting provision because I already thought this was in place, that you could basically test the two groups separately of excludable and non-excludable employees. You can do that for the non-discrimination tests, but that wasn't possible for top heavy. Now under Secure 2.0, that is possible. So a top heavy test, you can have two groups that you're testing separately, the excludable and the non-excludable employees.
Great. The next one, are there limits on the number of times you can withdraw assets from the emergency savings accounts, maybe annually, a number of withdrawals?
Yes, I believe there are. Let me just double check here. Let's see, participants, they must be allowed to take withdrawals at least once a month. There can be no charges, fees, etc., applied to the first 4 withdrawals. So that seems to be, the requirement to take one at least once a month.
Great. Next one, domestic abuse provision. Will spousal consent be waived for those distributions?
That's a wonderful question. I would venture to say that would be the case. But here again, it's an optional provision. Let's see. Yeah, at this point, I would say it would almost have to be.
Okay, great. With regards to the domestic abuse withdrawal, is it the duty to report to law enforcement?
Oh, there is no reference to that in the statute at this point, or excuse me, in the law. So I would say no. Probably doesn't, that would be too far reaching for this type of legislation.
Okay, great. And I just want to check in with you, Jenny. How are you on time? Are you able for a few more, or should we stop here? I'll leave it up to you.
Yeah, it might be nice to wrap it up, but if you have any additional questions, I'd be happy to follow up with email, and then I'll provide that additional handout.
Okay, great. Yeah, so as she just said, what we'll do is we'll make sure, apologies if your question has not been answered thus far, but we will have note of them here and make sure that we get them to you individually. I want to thank everybody for their time. I'm going to go ahead and toss it back over to Darren to close us out. Thanks a lot, everybody.
Thank you, Travis. Thank you, Jenny. If you'd like to continue your conversation, you can contact your RLC representative or your TRA regional plan consultant. In the next couple of days, we'll be sending over a follow-up email with a copy of the presentation deck, the link to the recorded webinar and supporting materials, so watch for that. When we close the webinar, there will be a short survey. If you can take just a few minutes and complete that survey, we'd greatly appreciate it. And again, we appreciate your time and participation today, and we hope you have a great rest of your day. Thank you.